The art of taxation consists in so plucking the goose as to get the most feathers with the least hissing. This insightful quote was from the Minister of Finance in France in the 1600s. I'm Glenn Frank, Director of Investment Tax Strategy at Lexington Wealth Management. I've been teaching portfolio construction courses at Bentley University for 20 years. So how do you keep from getting goosed? The answer is location, location, location. For portfolio taxes, where you place investments, the location is every bit as important as it is for real estate. To minimize usually the largest expense, you must put the right investments in the right place. So here is our 5-step investment process. After the third step, asset class capture, comes today's focus, asset location. Where will you actually hold those investments? If it's a mutual fund, for example, will you hold it in an IRA, in a taxable account, in a Roth, a trust, what have you? Two key factors in the investment process you can control are your emotions and costs, which include taxes. And read my lips, you can control portfolio taxes. Vanguard, one of the most trustworthy companies in our industry, attempted to quantify these two factors in a recent study. The study indicated that behavioral management might be worth as much as 1.5% per year in returns to investors. The main reason is that investors tend to blow in the wind with fear one day and greed the next. In the study, Vanguard broke tax costs into the two phases of a portfolio's tax life, before retirement and after retirement, or as I like to refer to them as the accumulation phase and the decumulation phase. In the accumulation phase, taxpayers are often in a higher tax bracket and it's absolutely critical to get investments in the right location. In the decumulation phase, investors are often in a lower tax bracket. And figuring out how to pull money out of your portfolio for lifestyle, the ordering is crucial. Do I take money out of my IRAs first, my Roths, my taxable accounts, within the taxable, the high basis parts, the low basis parts? Very tricky. And at the same time, you have to keep the essence of the portfolio intact. There are other important tax efforts that can generate even more alpha. For example, Roth conversions, loss harvesting, which assets to give to charity. Per numerous studies, all these tax efforts can be worth well over 1% per year. Note that emotions and taxes are often intertwined. Investors typically have a visceral reaction to paying taxes. Cutting checks on April 15th is painful. But like I often say, the tax tail should not wag the dog. It is about your returns after taxes. Sometimes it's better to pay taxes while the gains still exist. You know, buy high, sell low. So sometimes it is prudent to sell your winners. Although thoughtful, advanced asset location can mitigate this conundrum. Let's crystallize the importance of asset location by going through a fairly simple example. First, the facts. An investor with $200,000 would like to invest 1/2 in the S&P 500 index and 1/2 in an actively managed real estate fund. The reason we chose these two asset classes is they both have the same long-term annual returns, but the composition of those returns is quite different when it comes to taxes. Another fact is the investor has $100,000 in a taxable account and $100,000 in a retirement account. So now the question becomes, what goes where? Before answering the question about what investment goes into which account, we need to understand the tax efficiency of each investment.
The S&P is very tax efficient. Both dividends and cap gains get preferential lower tax rates. Plus, the majority of tax is deferred until the investment is sold, which may not be for many years. Alternatively, the real estate fund has a majority of its returns being taxed as ordinary income each year coming from the rents. Plus, active management usually means frequent cap gain distributions. So let's look at two location options. Under option A, which we've labeled the tax smart approach, we put the tax efficient S&P 500 in the taxable account, and we put the REIT in the retirement account. Under option B, we've labeled tax not so smart. We did the opposite. The accumulation difference is really quite significant. There's 17% more money under option A than under option B. And this is just the income tax savings. There could be even more savings. A big part of option A assumed that the S&P 500 was sold in 20 years. Suppose it wasn't sold. Suppose it passed to the next generation. Suppose there was a step up in basis. So the difference would have been even more dramatic. In summation, there should only be one objective for long-term investors, and that's maximum total return after inflation and after taxes. So you gotta keep those tax feathers away from the IRS.